Welcome, everyone. I hope you're all having a pretty good week. I just wanted to say thank you so much for attending today's webinar. It is top of the hour, so we're going to go ahead and get started. I'm Reneika Lightbourne. I'm really delighted today to be joined by the one and only Kaylee McMahon. She is known as the Apartment Queen. She's also the founder and general partner for the Apartment Queen company, but also too, she has nearly $65 million in asset under management. So Kaylee, thank you once more for being today's featured speaker. I don't know if you're able to unmute, but also too, today we're going to be covering how to invest in real estate through crowdfunding. Also, Kaylee will cover some of the rules and regulations relating to us, I guess, surrounding crowdfunding. And of course, you'll be able to get your questions answered. But before I turn it over, I just want to give you a general overview of what self-direction is, the steps to get started with us, also the different account types. So feel free to type your questions. We'll allocate time at the very end to get those answered. And I will So again, I'm Reneika Lightbourne. I'm a business development professional here at Advanta. I've been with Advanta as an employee since 2019, so going on a little over almost 3 years now. But I'm also a client of Advanta as well. Self-directing is something that I actively do. If you have questions, if you want to do a deeper dive on your particular situation, you're always welcome to give me a call directly or send me an email or visit us at advantaira.com to schedule a consultation. So just a little housekeeping before we get started. Just know that at Advanta, we don't give any tax, legal, or investment advice. We also don't endorse any particular products. We always encourage you to do your own due diligence, consult with your professional team. So just know that the information that's going to be presented today is just more so educational purposes. Just 3 quick takeaways. First and foremost, know that any IRA or former employer plan qualifies to be self-directed. With self-directing, you're always in control, so you choose the investment that works best for you. But today we're going to be talking about crowdfunding, real estate-related apartment complexes, and so forth. And then, of course, knowing that all of the income that's generated from that investment flows back into the IRA. If there's any expenses associated with that investment, it's paid out from the IRA itself. Just a little history about Advanta and who we are. We've been in business for nearly 20 years as one of the leading self-directed IRA administrators. Our headquarters is in Largo, Florida, but we do have an office in Atlanta, which is where I'm based. But Advanta work with clients nationwide, as we do have a little over $2 billion under our administration. If you have any cash that's just sitting with us, just know that it is FDIC insured up to the standard amounts. And then, of course, the way we set ourselves apart is by providing our clients that concierge style service, that direct point of contact where you have an assigned account manager that's going to be with you for the life of your investment, your account with us. And then, of course, doing great educational platform where we have guest speakers and experts like Kaylee come on and present. We also do an in-house online networking event called Pitch, Promote, Prosper. So definitely feel free to check out our events page to sign up. And we have a great blog that's a pretty good resource for you. Our webinars are recorded, so this will be up on our YouTube channel, as well as Advanta. We also have a podcast that's hosted by my colleague, Alex Parney. So exactly what is a self-directed IRA? Very simply, a self-directed IRA just means that you as the account owner have complete control over your retirement funds. You have complete control over the investment decision in terms of what is it that you want to invest in. But also, too, it allows you to really diversify your account outside of the traditional stocks and bonds. In terms of the different types of assets that can be self-directed, it is narrow limitless, but I'll just touch on, the most obvious real estate. So whether it's a, single family home, today we're going to be talking about multifamily or commercial projects. You can certainly also use IRA funds to invest in the likes of tax liens and tax deeds, notes and mortgages, You can be creative with, leasing out or farm animals or heavy equipment, precious metals. The list goes on and on in terms of the options available to you. In actuality, the IRS says there's only 2 investments you cannot make. That's life insurance and collectibles. Collectibles being antique art, wine, stamps, anything of that nature. Outside of that, pretty much the sky's the limit in terms of what you can invest in. So exactly, why do people choose to self-direct? For you, it may be any number of reasons. I'll just touch on 3. 1, it's a new source of capital for you. If you have an old 401k that you've left an employer 5-10 years ago and that fund's just sitting idle, you can elect to roll that over into an IRA with us and put it to work into a real estate related project or whatever else you decide to. Also, too, the ups and downs, the fatigue in the stock market. Obviously, something that can be happening on a global scale overseas can impact the stock market here. So a lot of investors like the ability to invest in using a self-directed just because you can kind of diversify into other assets. And then, of course, the tax benefits. Having those rents, those profits, those dividends flow back into your retirement account, tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, it's the accounts that you're already familiar with. For individuals, you have traditional IRAs and Roth IRAs. With traditional, it's tax-deferred. You get your tax break up front. And then, of course, at retirement, that's when you pay taxes. Whereas with a Roth, you get to pay the taxes up front, grow it over time. When you take it out at retirement, as long as you've had that account for at least 5 years, it is tax-free. And then, of course, if you are a, small business or you have a side business or an entrepreneur, you can certainly look to self-direct pay SEP, simple or solo 401k. Solo 401k, a lot of real estate investors really like it just because of flexibility. You have higher contribution limits, and I'll touch on those limits shortly. And then some lesser known accounts that can also be self-directed includes educational savings accounts. So if you have, kids or nieces and nephews, you can certainly cover their educational related expenses. And then an HSA to cover medical expenses. As long as you have a high deductible plan, you can participate in the HSA. Definitely confer with your plan provider to ensure that you have a high deductible plan. And then, of course, any former employer plan qualifies to be self-directed. So whether that's an old 401k or 403b or a TSP type plan, you can certainly look to self-direct. The only time there's a restriction is if you're not 59 and a half and it's a current employer, most times they will restrict you from moving those funds. There are some exceptions to where they may allow you to move a portion, but definitely confer with them. In terms of the contribution limits, also too, I do want to let you know that the contribution limits for 2021 deadline is actually Monday the 18th. So if you've not yet made your contribution and you want to for 2021, definitely get those contributions in. For traditional and Roth IRAs, you can contribute $6,000 if you're under the age of 50, $7,000 if you're over 50. For SEP IRA, you can put 25% of your compensation, not to exceed $61,000. With a 401k, again, it has a lot more flexibility. You get to contribute twice, once as an employee and also an employer match. You can put up to possibly $61,000 if you're under the age of 50, or $67,500 if you're over 50. For ESA, you can put in $2,000 per year per child. With an HSA, if it's an individual plan, you can put in $3,650, or if it's a family plan, then you can put in $7,300. If you're 55 years and older with an HSA, you have that additional $1,000 catch up. In terms of when you're ready to get started, at Advanta, we're here to really streamline that process for you in 3 simple steps. First and foremost, you would fill out the application, the paperwork to get your account open. You can do that electronically via DocuSign with us. We'll be there to walk you through that step. And then also, too, once your account is open, you will be paired with a dedicated account manager. Step 2 is funding the account. You have a couple of ways. Again, if you have a former employer plan, you can do a direct rollover of those funds. In that scenario, you would initiate that request, letting that administrator know that you want to move it over into another retirement account. There's no tax liability for you to do so. If it's an IRA in that scenario, Advanta will actually submit that request over to your other IRA custodian. You can move as much or as little as you need to make your investment. Again, there's no tax liabilities for you to do that. And then again, each year the IRS allows you to make an annual cash contribution as long as you have earned income. And then finally, step 3, start investing. What is it that you have an interest in? Are you a passive investor? Do you want to participate in a crowdfunding opportunity to invest in an apartment? The sky is the limit when it comes to self-directing. And with that, I'll go ahead and turn it over to our guest speaker, Kaylee. Hi, how are you?
I'm doing okay today. How are you feeling?
I'm doing wonderful. Let me make you the presenter. Just bear with me one moment.
If I want to share my screen, where is the button? I'm used to Zoom.
Okay, so I just sent it to you. So I gave you the option to.
Hopefully this works. I think so, yeah. So everybody, thank you so much for joining. Hopefully you can hear me. I'm going to turn up my volume a little bit if that helps. And my name is Kaylee McMahon, and this is a presentation on crowdfunding basics. So there will be some basics, some not so basics, but thank you for joining today, and I look forward to helping you guys change the face of multifamily real estate. So a little bit about us. Apartment Queen Investments is the name of our company. We're an experienced operator team, over 64 million AUM. We actually have 74 now, going after another $12.5 million deal. Landlord, business friendly, and tax friendly states is where we invest, primarily focused in Texas, and we've got some pretty big goals. 200 million assets under management total by 2022, so this year, and to create $1 billion invested for Shevesters by 2030. What is crowdfunding? You're like, oh, I've heard of this on Indiegogo, Kickstarter. We'll cover that in a minute. But crowdfunding is a new and evolving method of using the internet to raise capital to support a wide range of ideas and ventures. An entity or individual raising funds through crowdfunding seeks small contributions from a large number of people, as you can see in this photo. Individuals in that crowd are considered, or in the campaign are considered the crowd. May share information about the project, cause. That's the big kicker behind these. It's usually mission-based. Ideas or businesses with each other, and the information to decide whether to fund the campaign is based on the collective wisdom of the crowd. So types of crowdfunding that there are out there: there's donations, there's reward, there's equity, and there's debt. So what we do is we do equity. Types of crowdfunding. So again, debt-based and equity-based. What does that mean? Contributors receive interest payments in exchange for their contributions. So here's some examples of crowdfunding platforms that offer that to you. Funded Here, Crowdo, Moolah Sense, GoFundMe. I'm sure you've heard of GoFundMe. Equity-based platforms. I'm also using a different one I'll show you in a minute. It's called Crowdfund Main Street, but that's over on this side. Equity-based platforms like Fundnell, Cedars, AngelList, CapBridge. They give contributors receive shares in exchange for their contributions, which is typically how we do a normal Reg D deal, but this is actually Reg C, so I will go over that later again. I'm kind of getting ahead. So types of crowdfunding, again, reward-based, donation-based. Contributors are promised rewards in exchange for their support through first priority access to the product once it goes live. So Indiegogo is an example, Kickstarter is another example. I had my app on Kickstarter. So that's reward-based. Now donations-based is charitable, and they're tax deductible. So that's another set of platforms like Friend Fund, UCare, and Patreon. I'm sure you've heard of Patreon. So those are some more types of crowdfunding. What is regulation crowdfunding? Reg CF, or crowdfunding, involves submitting a Form C. So not to get too technical for you, but normally what syndicators or apartment operators do when they get a pool of money together is they do a Reg D as in Delta, and that would be a Form D that they're turning in, Delta again, to the SEC. And this is another particular type of SEC exemption. Regulation crowdfunding enables eligible companies to offer and sell securities through crowdfunding, but to a different type of audience. So regulation crowdfunding, Form C, again, not D. Crowdfunding law is important to be aware of how that works. So we have a separate attorney that does Form C versus our Form D. Crowdfunding portals, again, work differently. They take a fee percentage. They are absolutely required by FINRA, actually, for us to be able to even offer crowdfunding. That will be hopefully changing soon, state by state, but it is what it is right now. Raising capital typically happens through a hosted demo day. So for example, if I was to give a different version of this PowerPoint in front of all of our potential contributors, we would call it a demo day, where I'm basically pitching our company, what we do, and then what you get out of it to our investors. Both accredited and non-accredited investors can invest, but there are investment limitations for the non-accredited. So we actually have two offerings with our company, where we have one for the accredited and one for everybody else. So that is what we're using crowdfunding for. So crowdfunding law, there's business law, there's securities law, and then there's crowdfunding law. Let's talk about that. So the rules, it requires that all transactions under crowdfunding to take place online through an SEC and FINRA registered intermediary, either a broker dealer or a funding portal. So it has to be a registered FINRA broker dealer. So that means a whole other set of things, and you can Google what that means. Like a broker dealer, there's a website for this. If you want to check if they're registered, they have to go through certain restrictions and certain vetting before they're allowed to do this. They have to, the rules are that it permits a company to raise a maximum aggregate amount of $5 million through crowdfunding offering in a 12-month period. Now, the reason why we are even looking at crowdfunding is because it changed in 2021 in March, finally, where the 1 million max that we could raise on crowdfunding went 5x. So now we can do 5 million. So that starts to make more sense for doing a real estate deal. Before, it just didn't make any sense. Before, it was essentially like pre-seed capital for maybe a tech company. So another rule is that there's a limited amount the individual non-accredited investors can invest across all crowdfunding platforms for a 12-month period. So you're locked at a max, and I'll cover that later, what that looks like. It requires disclosure of information and filings with the commission and to the investors and the intermediary facilitating the offering. So in this particular point, in Regulation D or Delta offerings that we've been doing before, we've never had to disclose like all of our bank accounts have annual audits. There's just more stringent regulations that we have to adhere to and then make available to our investors. And that's what it means with disclosure of information in the filings and then on a continual basis as well. It doesn't mention that, but on an annual basis, we have to update those. So whether it's a review, financial review, or whether it's an audit, there's certain levels that require each different type of review. And then again, that's put in front of the investors. So it's a little bit more than just having your property management company print off financials and you hope that they're right. It's actually audited. So they have to be not just given to you, but they have to be correct and audited. So let's see, crowdfunding portals. In contrast, the crowdfunding platform is like an online marketplace with fundraisers. They can connect investors to fund their projects independently. Again, unlike broker dealers, crowdfunding portals have a number of limitations to the kind of activities and services they can perform. Crowdfunding portal examples, so I wanted to show you guys this is just a screenshot of Crowdfund Main Street. So this is the one that we chose. And the reason we chose this one is because what we do at Apartment Queen Investments is we look to impact women and make sure that they are financially literate and make sure that they have investing opportunities once they are literate. So we have a whole ecosystem we're building, but it's for impact. So our investments aren't just for cash. They're also, you get returns and you actually do something to the community. So this is the portal that has 100,000 plus angel investors on it who are all obsessed with impact investing. So this is why we chose this. And also, honestly, the attorney that owns this platform, she's a Duke graduate. She's super sharp. They can take cryptocurrency. They can take IRAs and retirement accounts through Crowdfund Main Street. And they have a whole back end onboarding process for each investor. So we really did like utilizing them before. So an accredited investor, I just want to make it clear with everybody what currently an accredited investor is. I'm not going to read all these off, but essentially a bank, savings, loan association, loan company, insurance company, registered investment company, trust, Indian tribe, and then any business really that has excess assets of 5 million as a group. Then also same thing with charitable organization, corp, limited liability, like all of the business entities basically qualify. Again, an individual with a net worth or joint net worth with a spouse of 1 million, not including their primary residence. An individual with an income exceeding 200,000 per year for 2 years consecutively, or a couple, or actually partners are considered, now you don't have to be married, exceeding together 300,000 for those 2 years, and reasonable expectation to continue the same income level in the future. So basically, those are all the things that would say, hey, I'm an accredited qualified investor. And then this is something that we have another, again, Reg D offering for, but these individuals, so normally this was the qualification that you had to have to invest into publicly marketable offerings, essentially, and especially in real estate. So now this is not required to do a crowdfunding investment. So like I mentioned earlier, crowdfunding requires that investors are capped. We want to make sure, because if I'm taking grandma's money and she's got not very much money, that if she loses it all, for example, that it's not going to harm their life. And this is one thing that I see different between Reg CF and Reg D, is Reg D pretty much just has you sign off a piece of paper that either you're knowledgeable enough to lose all your money, or you have enough extra backup money to lose all your money and be okay with it. That's essentially, so it's like you just sign a waiver, essentially, is what Reg D is. This is a little more strict. So I want to really protect the investors, and even the types of wording I can use in my ads are all, I have tons of rules I have to follow to let the investor decide what's best for them. So essentially, to get down to it, there's a chart right here. So for example, the rules are, if you have a net worth or income below 107,000, the investor may invest up to 5% of the higher number income or net worth. Anyone can invest at least $2,200 bucks. Our offering starts at 5,000. minimum, and that again is for a 12-month period. But anyone that is not accredited cannot invest more than $107,000. So you're capped. So if both income and net worth are above 107,000, again, that cap is still, or are above 107, the max percentage jumps to 10% of the higher number. So you can see a little breakdown chart right here. I'm happy to share this afterwards, but essentially, so you can see someone that has like an annual income of 30,000, they'd be limited for a year to invest with us 2,200 bucks. If someone makes 200,000 a year, then they have a 12-month limit of $20,000. And then if they have more income, then they can actually invest more. So this actually has us unable to take as much funding as we used to. But again, it's important to me to lower the barrier to entry to these assets. And I didn't invest in multifamily for a long time. But my first investment was a passive investment in a house note, and it was for $5,000. So I thought, how can we give people access to this stable income that's not going to go anywhere? You know, people always need a roof over their head. This is how we'll do it. So benefits of crowdfunding versus Regulation D offerings, as I keep saying, is that we can, again, publicly advertise both of these offerings, but our Reg D is a 506C is in CAT or commercial. Anyone can invest in a crowdfunding offering. So like I mentioned, family members, friends, the general public, grandma, anybody. There's no specifics on the type of investor you are, if you're qualified, non-qualified, you're able to invest. It's again open to the general population to expand the investments into multifamily. So we try to create equal opportunity for each investment. And investing in Reg Ds, it's limited to, like I said, only two types of qualified investors: accredited and sophisticated. And I know a lot of people that, you know, for example, they're not a U.S. citizen, but they have a bank account here, but they're not considered accredited, if you will, for example. But because of certain other things, they're not sophisticated, but they have $900,000 to invest, like sitting around. So there's always those people that are in between that get left out. And I found that about 12 to 13% of the U.S. population actually qualifies to invest into Reg D offerings. And so then, you know, for crowdfunding, let's give that to 88% of the rest of the people. There again are net worth requirements, and they will be changing as well, creating a bigger gap for you to invest in multifamily. And I saw this coming, and I thought, what can we do about this? So as of, I think, a month ago, what is this, April? Yes, about a month ago, there are rumors with the SEC that they are going to be increasing the net worth qualification for Reg D, because this was based quite a while ago where it was the million minus your primary. And now people's incomes have skyrocketed and inflation has happened and things have changed. They're reevaluating. I've been told it's supposed to be 10 million net worth to be considered accredited, but I think it's going to fall closer, maybe like 5. But I mean, that's going to, again, widen that gap for those people to even get access to these good offerings. So again, what can we do about it? Crowdfunding. Investing in crowdfunding. So like I mentioned earlier, the SEC changed in March of 2021 to create more accredited households, 12 million more accredited households in the United States, actually. And like I mentioned, the max raise for us went from 1 million to 5 million, which means there is more security for us to be able to get bigger deals, afford less expense for salaries for property managers. The bigger the property, the better it is to invest in. So again, crowdfunding started to make sense to do a raise for a big multifamily, say 100, 200 unit complex, and be able to continue to have a more stable asset, cheaper supplies, save on expenses, and increase profit. So before it was like, okay, if I can raise a max of 1 million, what kind of an asset in this market can I actually buy? It was like, you know, teeny tiny piddly, lots and lots of work, very high expenses. It just didn't make sense. So again, we can raise now 5 times more than we could through crowdfunding. So I want to share with you, so what we've done for our specific type of offering is that we have a fund, overall fund. I don't want to make this too complicated. Again, there's a 506c side, and then there's a crowdfunding side. So the crowdfunding and the other, both sides of this offering, essentially, whether you qualify for A or B, go to the same assets. Now, so we are calling it a fund, burn a fund particularly. Now, the crowdfunding offering itself, once your money goes into the crowdfunding offering, it actually has to invest directly into the asset. So it's a little different than the fund, but it is still under the name burn a fund. But I do want to let you know that essentially when you invest in a crowdfund offering, it is a pool of money. So it is still basically a fund, but a fund means the documents. So I do want to let you know what happens. Everyone's like, well, if I'm not investing either side, I want to give you the advantages of what pooling your money together does for you in a fund. So diversification, again, you're not in one deal, illiquid, waiting on your cash. Instead, you're in different deals, which all have to sell, refinance, excess cash flow, capital events happening on multiple different properties at different times. It's highly unlikely that all of the assets would underperform at the same time. So likely we can pay investors out without having to hold off because something happens with one market, etc. You can take your 50K, for example, or 25K or 5 or whatever it is, and then you're invested in X amount of doors. So say if the has 1,000 doors purchased, then you're actually going to be an owner for your one investment in all of those different assets. So then again, that makes your money go a lot further. And so that's not possible through single asset syndication. More transparency. So again, we are having to now submit with crowdfunding audited financials once we get past 1 million raised, which we are past that now. We're having to do financial reviews before we can even launch the offering. So essentially these are available on the crowdfunding platform for the investors. So that means more transparency. We use a discounted cash flow method to value our monthly property level accounting books. And annually, again, we're required to have a full audit. So the audit is available to all investors. In the past, I'll be transparent with you, investors to be able to get what they want from these offerings. I want numbers, I want explanations, I want to know that the books are, again, audited and they're actually correct. The only way in the past investors could get that would be to demand, to sue, to request, to threaten when they think something is off. Instead, this is just fully available all the time. So I find that transparency is always good. We have a dedicated, and each fund should have a dedicated CPA that their job is to comb through the property level books looking for red flags. So they are in touch with each different asset that the fund is invested in. You get 1K1, that's a cool thing with a fund. So normally if you're in 7 deals or 5 deals, for example, you have 7 different K1 documents that you have to hunt down. I'm doing that right now through 9 properties, and it is such a pain. You just get 1. So essentially it's a lot easier to get that wrangled up to your CPA and get it in on time. We just give you 1. So mission-driven investment, again, with this particular fund, you're putting your money into a cause that you care about versus only getting richer. So that's another thing with this crowdfund Main Street platform and crowdfunding in general. Usually there is a mission behind what is being built and given to the crowd or the community. The point in crowdfund Main Street is to be able to affect your Main Street versus Wall Street. So the community is important to us. You're able to invest in more units overall with one small investment and take advantage of downturns. So for example, you're spread out across, say, 1,000 units, for example, and when there's a mass of units, that helps to get away from issues where, for example, if you had 1 unit or 4 units or something and it went 100% vacant, or so 1 person left, you're 100% vacant, 4 units, 2 people left, you're 50% vacant. The more units overall that you have access to for your investments, the less you'll feel the disadvantage of a downturn. So it is advantageous. So for this example, again, it's important for you to have legal counsel. This particular fund that we did was a closed-end fund. So sometimes other funds out there will reinvest your refinance at sale or take your profits. So profits from refi or sale, they'll put it into a parallel fund that's happening at the same time that maybe goes into another kind of apartment or whatever. This one, that's not going to happen. So essentially, once profits are made and it gets to the investors' payout that they need, then they get their exit check. And our projected exit for this fund is a 5-year time frame, and that's typical for our deals. But again, because there's several assets, it shouldn't take that long. There is an 80-20 split on this fund. You want to look for that. You know, what is my IRR? What is my cash-on-cash return annualized? What is my split? We did that because we wanted to be pretty generous with this first one. And again, like I mentioned, we can take in this particular arrangement non-accredited, non-sophisticated investors. So if you don't have 50K, if you don't have 40, if you don't have 20, there's something for you. You still get to be involved in the best asset class for tax benefits and recession-resistant investing. You don't miss out on a good deal. So there's a bunch. And again, you want to make sure that your time is valued. So the last point I'll make is just normally we're at all these events trying to find different sponsors to figure out another deal and another deal and another deal. Instead of dating and trying to find a way to trust a new person all the time, it's exhausting. Once you find a set of sponsors that you trust and they have a fund available for you, and you know what their track record is, and you know what types of deals that they have and continue to invest in, it again helps you to reduce the amount of networking and dating you have to do, and you're able to just continue with the same sponsor and let them continue to find new deals, and you're in on them already. So in this situation, what we did was in each crowdfunding platform, I think you can move your investment down to $500. Like for example, if you're doing like a startup for an app or something like that, we decided to change our minimum to $5,000. And then if you're an angel, for example, or if there's seed capital, which doesn't apply typically, it could to IRAs or retirement accounts. This is what we're targeting for those investors who are going to be on the equity side, or sorry, not equity side, the possible general partner side or co-GP or preferred equity side of the fund. So the use of the funds that we will be using is marketing, educational events for the particular deal, earnest money deposit, feasibility costs, legal fees, and then there's other soft costs. So that is, and then of course the acquisition of the property and the development part of it. I don't know why that's not in there. I will change that. And so if you're interested, you can register with us, of course. And this is my contact information. I'll give you the best one actually to text. So for example, if you want more information, or we actually just got approved on Friday by FINRA, I think last week, yeah, to have our Form C ready to go. And so it's not ready yet. So if you want to invest in the future crowdfunding offering, if you're not sophisticated, you're not qualified, you're not accredited, there is an opportunity to be able to use, like I said, retirement funds or cryptocurrency if you have it, for example, but it's just not ready. So if you want to get on that list, it's a wait list. My number you can send me the deal to is 214-699-8810. I would stick a link in the chat for you, but I don't know how to do that. It's not letting me. So that is everything.
Perfect. Thank you so much, Kaylee. That was great information. I do have some questions that's coming in. Just bear with me one moment. Let me pull those up. So will the slides be distributed? Yes. So we'll be able to send you a copy of the slides. Let me see. Is 200, 300 gross or modified adjusted gross income to be is considered to be an accredited investor?
Say that one more time.
So the question was, is 200K or 300K gross or a modified adjusted gross income is considered an accredited investor?
Yes.
Okay.
And then plus a bunch of all those entities, Indian tribes, etc., that you have 5 million in total assets. That's an accredited entity. Then also, I think I left this off there. If you're a financial advisor with an active license and you have a Series 6583, and then there's one more, you can see SEC.gov has them listed. You're actually considered knowledgeable and you're accredited. Also, if you're a fund employee and you have substantial knowledge of running the fund, you're also accredited. And those are some of the newest things that just changed in March of 21.
Okay, so another question is, when are you looking to go live with your crowdfunding campaign?
I wish I was responsible for that, but whenever the financial review is finished. So unfortunately, it's season, and we're working on getting K1s, and it's tax season, so they won't be able to start the last step of the process. It's taken since October to get the right attorney on this. She's a lobbyist from Washington D.C., so she knows very detailed. Let's just say that. So anyway, the point is I don't know the answer, but we have one step left, which is a financial review. And I have 6 CPAs that I have asked to do it, and so it just depends on when one of them can make some time to do it, and then it will take them like 2 days, nothing once they're ready. So let's hope by May 1st, but hopefully sooner. If you're on the wait list, you'll get an email immediately when it's ready.
Okay. Next question is, how will you communicate with your investors? Is it directly through the platform, or will you be sending out news releases, emails, monthly or quarterly reports?
Right, so I'm glad you asked for clarification on that, because we structured 4 different share classes. Again, I don't want to make it too complicated, but we have female and male investors, and the men bring in a mentee. They actually get a 25 basis point jump in their return after year 1, and we just want to do that because they can bring in a female to invest with them. So, so the question was, one more time, Reneika, sorry.
So the question was, how will you communicate with your investors? Is it through the platform, or will it be news releases, emails, monthly or quarterly reports?
communication. So each of those different classes, for example, if you're investing under 25,000, those are the investors that cannot directly book a call, text, have a meeting, go be, because that means like 5,000 people, and that's a lot, right? So if you're investing over $25,000, then you can book calls, come to our meetings direct, and have direct one-on-one communication. Everybody will get communication through the crowdfunding portal, however. So typically we do it monthly. I'd probably put in the docs to do it quarterly just to cover my butt if I get sick for a month or something, but normally it's every month that we have our updates that go out. So we probably do a news release once we do a new set. So for example, again, it's kind of complicated. I've had to do a lot of workarounds. So 5 million, the way that we've done it is we're doing a million, a million, a million. We're breaking it up into raise amount or raise segments. So each time we have a new segment we're opening, we're going to do a news release. And once it's closed, we'll do a new release. And then basically monthly, once you're invested, you'll be getting, or I put in a quarterly, but usually it's monthly, you'll be getting updates. And so that'll include the financials, that'll include anything that happens. So sometimes, we have flood, blood, fire, things that happen. And so I like to get videos or pictures and update the investors. There's been a distribution, any wacko expenses, that will also be additive, but typically it's monthly financials that you'll get on the platform.
Okay, so more questions. Where are you in terms of acquiring crowdfunded multifamily properties? Are you waiting on the fund before that? Like, do you have a list of properties?
So we have right now the accredited offering open. I'm calling it that. So basically it's the 506C offering open already. It's been open since last year. And so we have already invested 1.1, just say that, 1.1 million in 2 different assets as of right now. And so if you want to go to that site through, it's actually InvestNext is that portal for the accredited side of the offering. You can create a login and register, and you can go in there and you can see the financials, the offering video, projections, kind of all the normal stuff you normally see on the assets that are already invested into. So as of right now, that's 2. We're about to go after a 3rd. We've got another call while we're on this, where it's going to happen. But point is crowdfunding, we cannot take in any funds until the offering is fully complete. And again, financial review is the last thing we're waiting on. Then once it's done and it will be open, everyone will know, then we can take funds in through crowdfunding, and both of those sides will remain open, and those will invest into the same assets.
Okay, next question is, what is the reasonable return on one can expect in a multifamily offering?
I did a presentation on syndications on Tuesday night in Tulsa, and from what I'm looking at market, it looks like when an investor is looking at cash on cash annualized and they're looking at their internal rate of return or IRR, typically what a reasonable expectation for those would be based on market would be about 8% cash on cash and about 14% IRR. However, like our fund, for example, we have a minimum cash on cash annualized of 9 to 13%. I do have a range there, so basically a minimum of 9. And then when it comes to our internal rate of return, we have a minimum of 15. And I've been in projects that have, like this deal I'm getting a call about, has 25 IRR, so point is being in this fund, you may have some super rock star deals and you may have some deals that are just okay, but take advantage of all of them. So I would say that that's based on market, but our
Okay, follow-up question is, what are your target markets for the investment? Texas only or not limited to that single state?
So we have set up the fund right now. This could be something that we may actually change soon, because I just sent someone out to New Mexico and they found a deal able to make it work. And so it would just be a vote from all those voting members, and those are the members that invest over 25,000. You can vote, or we would just ask everyone if we can change the documents to include another asset in, like New Mexico. But right now, today, all we're investing in is Texas, and that's it.
Okay. Next question is, will UBIT apply to an equity crowdfunding?
Say that one more time. Sorry, it broke up.
Will UBIT, unrelated business income tax, apply to IRA if it's an equity-related crowdfunding deal?
Yeah, so it's the same thing as a Reg D, because essentially what the tax would be based on would be the entity that it's in. So for example, or not the entity that it's in, excuse me, if the asset itself, so whether it's a direct investment or indirect investment, if there's debt on the property, There's a couple of other triggers, but really, I mean, if we're doing debt on the property, which we are, we're doing bank loans, that will trigger that tax. And I don't want to say it will or it won't, but there's a couple of ways that when you come in with your IRA or your retirement account, if it's structured in the right way, there's a couple different types of accounts you can move it to. Once that type of account is invested into either crowdfunding or Reg D, any kind of equity offering, then you'd be protected against UDFI tax. So it really has to do with, is the sponsor using debt on the property, and then is my entity structured right? That's how you can figure out if you have that tax.
Okay. My next question is, who's on your team?
Sure. So on my team right now, we have Carolina DeMario. She is the data analyst. I would say numbers person, but really I think she's actually going to be a strong asset manager. We're just working to train her on that right now. Erica Neal is another member on our team. She came on as of last year. So Erica is extremely good at investor relations. She loves talking to people and walking them through whatever it is that you need. So that is her role. Myself right now, so when it comes to asset management, construction management, and acquisitions, that's been me, but as of now, a month ago, we now have an acquisitions individual. Brennan Lee is his name, and so we have those individuals. So acquisitions is covered. We're working on bringing on someone right now that's going to be focused on raising capital. Victoria is her name. She's being trained right now. So our team is rapidly scaling, but then also Amy Tiemann and I have done 2 deals together, and so we're kind of like seeing how those go. But she is extremely strong when it comes to construction. She's extremely strong when it comes to property management. She used to be a property manager, so she is part of our team. But we're working on if she wants to be in the fund or if she wants to just continue to do deals together. So she's on the team for a couple of these, but not all 9 of them.
Okay, great. Next question is, you mentioned that the deal is for 5 years. If I needed to exit before then, what are my options?
You don't have any options, to tell you the truth, because as it will say in your documents, for the crowdfunding offering, and actually either one, if there's a death from the family, then there's a procedure for moving shares and how that works exactly, and that happens, right? But for example, if you're just investing into something that you don't have the capital available to stay in that deal and let it grow, then the only other alternative that would happen would be if you had a qualified investor that could swap out, but we're not doing that with the crowdfunding, again, because these shares are so small. It's, say if we're raising $5 million for the fund and there's a $5,000 investment, imagine how many times people would be doing this. And on top of that, the person that exits has to know their share value. The individual investor leaving would have to pay for either an appraisal or some kind of valuation method, which are thousands and thousands of dollars. It would just eat up your investment to even figure out how to figure out what it's worth, and then to either put it essentially in the crowdfunding marketplace or find a qualified friend to swap out with. So it just says in the documents that if you're a crowdfunder, that they're illiquid. And for some of our accredited investors that invest above a certain amount, then again, if they bring in a qualified investor and they want to pay the fees to value their shares and figure that process out, then that's available. But typically just only with a passing of a family member. So again, if you don't have the money to invest, I invested in a invested passively in a house note, I think 6 years ago, something like that. And I just get 8% a month on a very small amount, but it's tax-free. It goes into my IRA. And I don't have to do anything. So I just leave it alone, So yeah, if you can't keep that money invested, I wouldn't invest.
Okay, let's see. Just bear with me one moment. I think something else just came up. Can you talk a little bit more about the, it says well, you answered that in the presentation in terms of which crowdfunding platform you use, but can you mention it once more?
Sure, it's Crowdfund Main Street.
Okay. All right, let's see. I think that covers all of the questions that that came in. We still have some time. Any
more questions for me?
No, so I will, if I can get a copy of your slides, I'll definitely be able to share it with the audience. Also, too, the recording will be up within 24 to 48 business hours. If you have specific questions relating to self-directing, definitely feel free to reach out to me here at AdvantaIRA.com. Give me a call, send me an email. Also, too, if you want to learn more about Kaylee's offerings or anything relating to what she has going on, especially with her upcoming crowdfunding campaign, definitely feel free to reach out to her. Let's see, something else came up.
I do have one thing I do want to make sure to put out there before everybody exits off and while we're recording as well. So one thing that will cause you to miss out possibly on any offerings, whether it's mine or whatever, is not having your self-directed IRA done. So if you have an IRA or retirement account and it's not yet self-directed, there is definitely a process to that. So for example, our wait list right now. So if everybody on that wait list put in just the minimum, we'd already have $2 million, boom, like tomorrow, done. And they have been waiting and chomping at the bit since last year to get a smaller amount invested into multifamily. So it's going to be speed of being able to utilize your funds. So do not wait to get your funds self-directed. For example, with that Crowdfund Main Street platform, they can take your self-directed IRA on the back end of the portal and have it go into the asset or into the deal, but or into the offering, but they can't do it for you. They can't self-direct. So that is 100% why we're on this call with Advanta, to make sure that we are touching base with Advanta, that Advanta is self-directing your account and you're ready to go as soon as whatever offering that you want to invest in is ready.
Great, yes, great input. Definitely, we can get your account going within 24 to 48 hours as long as we have all of the paperwork, so you can proactively get everything set up. So by the time that wait period is over, you're ready to go. I did have another question that came in, but I want to make sure I'm interpreting it correctly. It says, what is the recourse if it does not happen and exceeds investment period? So I think I'm missing something.
I think what they're saying, and clarify if I'm interpreting, because I'm just guessing, that what do I do? What can I do if the investment is longer than I'm expecting it to? So really, read your documents. That's the first thing you got to do. You got to make sure you read everything. So our projected exit is 5 years, but we did build in a 24-month window because we cannot predict what happens with the market, right? So if we do intend, actually in the next 2 years, there's a high risk right now of having market change and have a soft essentially. So what happens in that could dampen the deal, and then we need some ramp up time to make it, because the point is for that we keep the bills paid, and we make sure to keep the investment solid and never foreclose on that deal. So then when we sell, we can a recession were to happen. But point is what are my legal recourse methods able to out if it's 7 years and 1 day I haven't been paid $1, or looking at your documents, which are the offering documents, like Form PPM and a couple others. Your Form CF or Form C, excuse me, has it's not a PPM. What it has is a term sheet, excuse me, and then there's an offering document, summarized version of all the rate type stuff. So all it's like a buy-sell agreement, all of it listed in the operating agreement of the company. So how does that work? So essentially, when your window is up, it's have a conversation with the team. I absolutely have to have my money out. What can we do to get that done? So that built make sure that to get it does happen. So that and then you talk to the team, and then essentially the options would be to get out because your time has lapsed after, in this example, 7 years. And so it would be likely up to one of us individually as a team, or getting together with the other shareholders in the company and asking them, do they want shares? There's a process that's listed off in the operating agreement, and it's called a buy-sell of how that would work. So it's just a couple of steps. There's a stepwise process of exactly. Yeah, we want to make sure that that's clear because sometimes things happen.
Okay, great. I think that covers all of the questions. If you have any more questions, definitely now's the time to put it in the question box. And again, the recording will be up in 24 to 48 hours. We'll also provide you a link to it, a copy of the slides. And again, if you want to, talk more about your specific scenario when it comes to self-directing, definitely feel free to reach out to us. Kaylee, again, it's always a pleasure.
I'm going to send you the link to the wait list. I just can't send it out to the audience. I don't know why it won't let me. So I just sent that to you if you want to share it.
Okay, well, great. Thank you so very much. It's always a pleasure to connect with you, and look forward to doing more events in the future.
Yeah, absolutely. I'm always learning, so I like to teach. Thank you, guys.
It's a pleasure. Happy investing, everyone. Hope you have a great holiday weekend as well.